Hello everyone, as promised, we have a couple of PowerPoint slides that help us hopefully to understand the general principles of accounting and kind of how they relate to each other. This is based on the concept statements as in written form that we went over in our first podcast. Here's a little more visual, and we're going to concentrate on some of the qualitative principles that go along with accounting, these accounting principles. So here is our, you might say, conceptual framework visually. We talked about that the primary user group are investors and lenders. We're trying to give them information that will allow them to make decisions. So decision usefulness is our objective, to give them the kind of information they need. So when FASB tried to distill down what it was that it took to make information useful for decisions, they looked at, relevance and reliability. As the two pieces that make up decision usefulness. So if something is useful for decision making, it's because it's relevant. It has to do with what we're making our decision about. And I can trust it. It's reliable. That's what we're talking about here. So for it to be relevant, it either has to help us predict the future, predictive value. It means it helps us predict future cash flows. Remember, our focus is on future cash flows, or it provides us feedback about the past cash flows. And of course, we understand past cash flows are one of the best indicators of future cash flows. So if something is relevant, it is going to either help us predict or give us feedback on how we did in the past. That is what they refer to as fundamental qualitative characteristics. Now, to make something reliable, we need it to be free from error. Now, that's our goal. We will never be completely free from error in accounting, especially since we know we are making estimates. But we want to be as close to that as possible, and we'll talk about, perhaps where we will not be able to do so. We want it to be neutral, meaning it should not be biased based on our perception or our, we want certain things to happen a certain way, therefore we change how things are reported. We want it to be neutral so that one investment decision is not favored over another. And we can't leave things out. It has to be complete. So, of course, GAAP is going to try to give us what it means to be complete and have all the information we need to make that decision. So if we're going to, that's our focus, is to be relevant and reliable by providing this value, keeping it free from error, being neutral and complete. Now, that was not enough to truly you might say define where we need to go with our accounting. So they added what we call enhancing qualitative characteristics. You might say they're not the focus, but they are critical to being able to reach our focus. All right, so if you'll see how this might tie in, for instance, comparable. That means that the information from one company can compare to another. It's hard to have feedback if you can't compare the information from one period to another. You can't compare 2018 to 2019, or you can't compare Home Depot with Lowe's because they use different strategies or different rules. We need to try to make them comparable so that our information is relevant to the decision making. And of course, that also helps with reliability. because if we are comparable, that should indicate that we're neutral. Timely is we need the information within a time period that is reasonable to make that decision. That is why accounting tends to have deadlines. Many people, you talk about accounting, that's kind of their pet peeve in accounting, is that there are time constraints. I always feel, at least in some cases, at least certain periods of the time, to be rushed or have to be under the gun, because we need to provide the information in a timely way, because the longer it is from when it happened, the less relevant it is. All right, so if it's not timely, it's not going to be relevant. We don't care what happened 5 years ago. It needs to be timely. Okay, verifiable is how we become neutral and free from error. We can find verification of the information, the amount of measurement, or the existence of an asset is verifiable. That allows it to be, us to feel more like we can rely on it, and that it wasn't just someone's opinion, and therefore it's more neutral. And then the one that we probably wonder if they really believe in, and that is it has to be understandable. I mean, it can't be so complex and so unique to the company as to make it so, use jargon and things that can't be understood. So we need it to be clear enough so that otherwise, how can we rely on it? How could it be relevant if we can't understand it? Now, there's two constraints they put down here, two kind of ways that we need to look at things. First is a cost-benefit analysis. We could provide all the information, it just would be so expensive as to not be doable. And so therefore certain pieces of information or certain detailed information is not provided because the benefit does not outweigh the cost, and that is a judgment. But we realize that there are constraints to how much we can do and how exacting we can be about certain things. And certain amounts are not material. Materiality says that certain amounts are not enough to matter. Now, this does not mean that we intentionally make errors or leave anything out, because remember, our goal is still to be free from error. But we realize that when it comes time to make certain estimates, and if there are certain situations that may be judgment, we may not worry too much about the actual exact amount because the amount is not material. So when it comes time to identifying office supplies as an asset, we may decide that the amount is immaterial, it's too small to matter to our decision making, therefore it's not really relevant, and therefore we won't spend a lot of time trying to figure out what it is. In fact, we may even put all of the supplies as an expense, even though some are unused, some are still sitting around. And we may do that based on our decision that, based on this constraint of materiality, meaning that we cannot chase down every single dollar. It's not worth the cost, and it's not material to the overall position of the company when they're selling $5 billion worth of revenue to worry about how they account for toilet paper and whether it's properly accounted for as an asset or as an expense. And then the different things that will keep coming up with us all the rest of the semester: recognition and measurement. I have a separate, you might say, podcast on those specifically because there is detail about when to recognize and how to measure things. Presentation talks about, recognition says it belongs on the financial statements. Presentation says where and what does it look like? Does it go under assets? Does it go under expenses? Does it go into current or long-term assets? That sort of presentation issues. And then it also worries a little bit about how that should be presented in the footnotes. We talked about that in our first podcast. The sum detail is better described in the footnotes. And that is also what disclosure is about. What kinds of things do you need to describe about, say, accounts receivable, or about your long-lived assets and your calculation of depreciation? GAAP is going to tell us those things in disclosure. Now, one important principle to remember is you cannot make up for bad recognition with lots of extra disclosure, meaning if you have something in the wrong place or is presented wrong, measured wrong, or recognized incorrectly, you cannot just put in a disclosure that gives this long description that makes up for doing any of the others incorrectly. Specifically, the FASB did not want companies to use disclosure as a way of getting around bad presentation, or I should say bad, but weak or incorrect or borderline incorrect recognition, measurement, or presentation. Now, these next two slides we're going to do in the other podcasts on those. I want to have you look at this as a good summary of kind of how accounting works. It's a little hard to read. It's actually out of the concept statements, but I want you to think about journal entries and transactions and how they happen in accounting. So, first of all, when you think about changes on the balance sheet, there are 4 ways that things change. There's an exchange of an asset for an asset. You buy a building for cash. That's an exchange of an asset for an asset. You could exchange a liability for liability. You could borrow money from the bank to pay off your credit card. That's an exchange of one liability for another liability. So nothing happened on the income statement, nothing happened to equity. Either one of these, they just exchange an asset for an asset or a liability for a liability. Okay? You could acquire an asset by borrowing. So you buy a inventory on credit. You have an asset and you have a liability, no change in equity. The asset is increased, the liabilities are increased. Or you could pay off a liability by providing assets. So you pay that accounts payable off, or a loan payable, by using cash. Or you could pay it off with jelly beans, for that matter, as long as you are giving up an asset and reducing a liability. So your assets go down, your liabilities go down, nothing changes in equity. So those are the 4 changes that affect only the balance sheet, only assets and liabilities. If it affects equity, it fits down here. And we know that revenues and gains, revenues are the main component of our business. Gains are those that are peripheral to our business. That increases our equity. Expenses and losses decrease. Expenses being the main component of our business, losses peripheral. All of those affect comprehensive income. So these 4 all go on the income statement. There's a couple of gains and losses that are not part of the income statement but are part of comprehensive income. But basically, this is all the changes in equity that don't have to do with transactions from owners. So all of these affect equity, and they could affect an asset or liability. And usually do, but they don't just affect it like these over here. And then there is those transactions with the owners. If the owners put money in, we don't care what you call the investors, shareholders, stockholders, whatever. If they put money in, that's investment. If you distribute to them, usually referred to as dividends, that also changes equity, but it doesn't have anything to do with comprehensive income. So this is where these are where the balance sheet measures. Net income and comprehensive income measures these. Statement of changes in stockholders' equity measure these, or all of these, but particularly focus on these because these have already been measured. All right. And then last, that is fairly rare, is changes in equity that do not affect assets or liabilities. You transfer preferred stock for common stock. You transfer retained earnings for stock, something like that. Those are changes within equity that do not affect either assets or liabilities. That's literally everything that can happen in accounting in that chart. Everything we do, every journal entry, every transaction falls into one of those boxes. And being able to identify those and how they fit is the key to working through accounting. Okay, this is just a quick slide about some suggestions that investors have made about accounting. When they get the accounting information, they're not always happy that it has all of the things that they want in it. They made some recommendation. They want more, when they say disaggregation, more detail. They want more emphasis and explanation. They want more information about risks. They're worried about how we account for intangible assets. They want simpler language. They want more tables, more charts. They're not so sure that they believe us when it comes to materiality. We're wondering about that. Okay, so these are some of the things that investor groups have said we don't quite do as well as we should, and they made some suggestions to improve. So we have room for improvement. We have things that we need to do better at measuring and making it simpler and clearer for those who actually need this information to make their decisions. But we're constantly trying to improve, and the FASB is constantly tweaking the rules to try to do that. Sometimes they argue we're improving, sometimes we're going the wrong direction, but that's part of the challenge, is we're almost always changing in some way or another.